and walked up and draped it around the shoulders of the emperor. And the emperor said, I can't see it. And they said, oh, it's a very special gold cloak. Only really smart people can see this cloak. And so the emperor said, oh, I'm a very smart person. It's gorgeous. I really like how this cloak looks. Do you think you need to work on it a little more? And they said, yes, we'll need more money in order to finish up your cloak. And so the emperor gave the tailors more money, and they went away, and they spent the money on wine, women, and song. And they came back, again, with a cloak that's about as visible as the one I have here, and they made this big pretense of wrapping the cloak around the emperor, and they said, remember, this is a special cloak that only very bright people are able to see the cloak. And so the emperor, who could not see the cloak, but wanted to believe, and wanted everyone to believe that he was smart, said, oh, it's a beautiful cloak. I love my cloak. Okay. So now the emperor, perhaps it was more than just a cloak, because the emperor wanted, this is supposed to be his entire clothes, so go back and make it a cloak and a whole bunch of clothes as well. Anyway, so then there's a big parade, and the emperor's going to wear his new clothes in the parade, right? So he's going to wear his new clothes in the parade, and everybody in town knows that smart people can see the cloak, that there's this new gold cloak that the emperor has had made that can be seen by smart people, but not by people who are kind of dull, right? And so the emperor goes out, and he's walking in the parade with this cloak on, these clothes on, and nothing else. Well, there was no cloak, right? There was no cloak. And so he's walking along, buck naked. He's walking along through the town, naked as a jaybird, and this little 5-year-old kid says, Mama, he's naked. And she says, shh. And the kid says, but Mama, he's naked. And everybody else says, oh my gosh, he's right. The emperor is naked. It's not that we're all stupid, it's that the emperor is actually naked. So the emperor thought he was really smart, that he was smarter than everybody else, and he had this cloak that no one could see, but in fact there was no cloak, and the joke was on him. Thank you very much. Drink your warm milk, and now it's time to go to sleep, right? So the European Central Bank, when it said, we think these American mortgage-backed securities, which are based on subprime mortgages, which I'll talk about, God willing, the creek don't rise, how many people walk through in a few minutes, they said, we think these American mortgage-backed securities are terrible. These subprime mortgages are junk. They are not wonderful things that these high-paying 23-year-old financial whiz kids on Wall Street have sold to you, because the high-paying financial 23-year-old whiz kids on Wall Street had said, if you were as smart as I am, because after all I have a degree from ... if you were as smart as I was, you would understand these mortgage-backed securities. Everybody else was going, I think these things stink. No, that's just because you're just not as smart as I am. I, after all, majored in finance. That's a joke. They only went over for like half the class. The other half were like, oh, I want to major in finance. Aha, joke's on you. Anyway, so when the European Central Bank said these things stink, everybody else started saying, I thought so. I thought they were terrible. I thought they were awful. And it brought the whole thing, started to bring the whole thing down. So that was the first event. Where'd my clicker go? There it is. Okay. The second event, where am I? September of 2008. For reasons that I will explain in a few minutes. I should have done this in the other order. Ben Bernanke, who was chair of the Federal Reserve, and Hank Paulson, who was the Secretary of the Treasury, went into George Bush's office and said, give or take, and said, if we don't do something by 5 o'clock today, the world's financial markets will absolutely melt down and implode. The world's financial markets are about to cease functioning, and we have to do something, and we have to do something by 5 o'clock today. It was a panic moment. I was so glad I wasn't teaching that semester, because I wasn't sure how I was going to explain to everybody on the next day how it was that the entire financial system was imploding. It was a little scary. So they pulled the financial fire alarm, and then you see what happens here. Again, I didn't point out here. That they can't hit the target, and then here, they completely can't hit the target. And then, where's my next one? And then, starting in mid-December of 2008, the Fed lowered the federal funds rate target to 0, and that's as low as it can go. And since then, we sort of hugged the target. So the second challenge was that they couldn't meet the target, that the banks had other ideas. The third challenge we talked about, which is long-term interest rates. The Fed targets the federal funds rate, which is a short-term overnight rate. But the spending that's in aggregate demand depends upon other interest rates, and in particular, long-term interest rates are relevant for investment spending. Long-term rates typically change with short-term rates, but as we saw in that yield curve that I showed you last week, or the week before, whenever that was, the long-term rates did not come down as expected as they lowered the short-term rates. And so that was another challenge the Fed faced, was that those long-term rates were not coming down. So what the Fed started doing was they started buying long-term bonds in an effort to try to deliberately just move that long-term rate and lower that long-term rate. We saw some of that in that animated yield curve, where eventually the long-term rate did start to come down. But until long-term rates came down, there wasn't going to be any spurring to investment, because investment depends upon long-term, not overnight interest rates. Another challenge was the zero lower bound. The Fed hit the zero lower bound in December of 2008, when the target was set at in the range of 0 to 0.25%. The Fed couldn't lower interest rates below that, but certainly the economy didn't start taking off and roaring. It started improving a little bit starting in March of 2009. So the Fed, subsequent to 2008, tried a series of things they called quantitative easing. Quantitative easing, as I showed you the other day, quantitative easing was the Fed going out and buying up just about any kind of asset they could think of from the banks in an effort to increase the bank's excess reserves. But as we saw 4 slides back, the banks have not been lending those excess reserves. So the Fed did do the quantitative easing. It did increase excess reserves in the banking system. But now we're back to the first one. The Fed couldn't force the banks to lend those excess reserves. The banks have just been holding on to, at this point, I think $3 trillion worth of excess reserves. Everything that the Fed's been doing has been adding liquidity to the banking system. And one of the concerns that's been expressed for the last 4 or 5 years has been, has the Fed put too much liquidity into the banking system? We've got $3 trillion in excess reserves. What if tomorrow every bank were to decide to lend out all of their excess reserves? Wouldn't that just flood the economy with so much money and give us rampant inflation? There's like no way that there's enough demand for loans for the banks to lend all $3 trillion of those excess reserves tomorrow. So it's a concern that's been expressed. I think it's too much hyperbole attached to that concern. There's some validity to it, but you got to dial it back from the craziness that it gets discussed with sometimes. Okay, so those are all the challenges. Now let's back it up and talk about how we got there in the first place. Well, in recession, we got to talk about aggregate demand, because less aggregate demand means less output produced, which means fewer people employed, which means more people unemployed. And aggregate demand, as we know, is C plus I plus G plus net exports. In order to understand what happened in 2007, we have to talk about housing, because the housing crisis was a key part of what went wrong in so many different ways. So I'm going to start with talking about subprime mortgages. The technological development that makes this whole story possible is the development of FICO scores. FICO scores, that's your credit score. You have a FICO score. I have a FICO score. Everybody has a FICO score. They're out of 800. They're out of 800 because I figure everybody understands things out of 800, because that's the SAT is a maximum. Each test is a max of 800. So your FICO score comes out of a max of 800, and it's a number that's attached to you, and it's a measure of how likely you are to repay a loan if you're given a loan. So how many credit cards do you have? How much have you charged on them? How regularly are you repaying your loans? Have you ever been late with your loans? Do you have a job? All that kind of stuff goes into your FICO score, and everybody has a FICO score. And so since everybody has a FICO score, what this allows is what they call risk-based pricing. It means that the lenders can go through and say, you have a FICO score of 400 out of 800. You're a really big risk. If I'm going to lend to you, I'm going to charge you a very high interest rate. And they say, but you have a FICO score of 760 out of 800. You're a fabulous risk. You always pay back your loans. I'm going to charge you a really low interest rate. And so it's risk-based pricing. The loan rate that you're charged depends upon your FICO score, because your FICO score is a measure of the likelihood that you're going to repay the loan. The higher your FICO score, the better risk you are. The lower the interest rate you're going to pay. The lower your FICO score, the more likely you are to default. The higher the interest rate you're going to pay. With mortgages, which are loans to buy houses, there were 3 categories of mortgages: prime, subprime, and then something in the middle that they called Alt-A. A prime mortgage was, I didn't write this down, so give or take, so we're going to say approximately. It was a FICO that was, I think, greater than or equal to 660. It was a loan-to-value ratio, so loan divided by the value of the house, of no more than 80%. and an amount borrowed. There was a maximum number of dollars borrowed. I forget what it was. It was like 450,000 or something. Let's say, I'll bracket that, like 450,000, give or take. I forget what it was. So that was prime. So prime was good credit risk, have a lot of down payment that you're bringing to the mortgage, and not borrowing an outrageous amount of money. Subprime was a low FICO score and or borrowing a whole lot of money relative to the value of the house and or borrowing a lot of money, and then Alt-A was some little small slice in between. There wasn't, it's not like you can look at a loan document and it's not stamped prime, subprime, or Alt-A. The way that we figure out what was a prime mortgage and what was a subprime mortgage is by going back and saying what was this individual's FICO score, what was their loan to value ratio, how much were they borrowing, what interest rate were they charged, and what interest rate was being charged to other people in that same market at that same time. So it's an empirical determination after the fact, but it's the general thing is that they were dividing the market into good borrowers, borrowers, and then some sort of slice in the middle. After the year 2000, there are a bunch of new loan products that are introduced into the market. These 228s, 327s, teaser rates, and no-doc loans. A 228, I'm going to give you an example in just a minute. A 228 means you're going to borrow for 30 years. The first 2 years, you're going to pay interest only. And then over the next 28 years, you're going to start paying back the principal, the amount that you borrowed. 327, for the first 3 years, you're going to pay interest only. Over the next 27, you're going to pay back the principal as well as the interest. A teaser rate means they're going to give you a well below market rate for the first 2 or 3 years, depending upon whether you've got a 228 or a 327. I got a numerical example on the next slide. A no-doc loan means you go into the bank and you say, I want to borrow $750,000 to buy a house. And they say, okay, what's your income? And you say, I make $1 million a year. And they say, okay, and they write it down. They don't say, okay, show me your pay stub. They don't say, okay, show me your tax returns. They say, okay, and they write it down. That's a no-doc loan. So a no-doc loan increases. Talk about your asymmetric information problems, right? A no-doc loan offers this opportunity for people to basically make up amount of income. And then the other piece that's part of the story is mortgage-backed securities. Mortgage-backed securities means that what banks did was they hired J.P. Morgan type people to take a whole bunch of home mortgages. So they're going to take, let's say, 500 different home mortgages. So there's, let's say, one from each person in this room. We're going to take one home mortgage from each person in the room. We're going to bundle that all together. So we're going to bundle it all together. We're going to have this big bundle with all of our mortgages in it, the loans we've taken out to buy houses. And then we're going to chop that bundle up into 1,000 pieces. And we're going to sell each of those 1,000 pieces separately to somebody who wants to fund mortgages. So we're going to bundle together 500 or more mortgages. And then to each individual, we're going to sell 1/1000th of that bundle. People were quite happy to buy those mortgages. That's called a mortgage-backed security, that 1/1000th. People were very happy to buy those because they figured there was very little risk they were going to lose. Because, you know, my gosh, there's all these different people who are in this bundle. What's the odds that they're all going to default at the same time? Right? And so they figured the risk was really diversified, and so they bought these bundles, and those are called mortgage-backed securities. So if you look at what happens to the funding of mortgages over time, so this one starts in 1960 down here on the left and runs through 2011, at which point the data stopped being available. Interesting, isn't that? This line here is savings and loans. So that's places like Washington Mutual, which has been bought out by somebody else. Savings and loans traditionally made almost half of home mortgages. Look at the big decline here. This line that's going up, those are your mortgage-backed securities. And so instead of home loans being made by banks and other financial institutions, the people who were funding the home loans were increasingly these what they call mortgage pools. That is, the folks who were buying those mortgage-backed securities. They were sold to everybody. Anybody could buy them. They were in people's retirement funds. Banks bought them. Governments bought them. They were all around the world. Everywhere. Housing prices soared. I'm not going to take time to do this. It's supply and demand, so downward sloping demand, upward sloping supply. Easy credit, shift your demand curve to the right. There you go, demand 2. There you go. Price of housing goes up. Straightforward supply and demand. So you get really easy credit. It becomes much easier for people to get loans. Loans are complements to buying a house. Much easier to get a loan. That's going to increase the demand for housing. We get a huge increase in housing prices. So it doesn't really matter which line you look at. They're telling the same story. Here's housing prices. Housing prices are going up somewhat gradually, and then boom, here we go. Here's 2000, and here the housing prices start to really soar. As these mortgage-backed securities, the money basically is churning through the financial institutions really fast. Because they make the home loan, instead of holding it for 30 years, they bundle it up and sell it the next day. Then they can make more home loans the next day. So we get big increase in demand for houses because it's easy to get a loan. Housing prices soar. This is an index, but you can basically, it's going to go from 100 here to 200 here. So housing prices double in a very, very short period of time. All right, why is that a problem? Here you go. So the typical product was a 228 with a teaser rate. So here's an example. You're going to borrow $400,000. So you found a house you want to buy. It's a $400,000 house. You go in. You don't really have a very good credit record. Your FICO score is not so good. You've got some credit card debt that's outstanding. You've missed some payments on a few things. You go in and you don't have a down payment. You have no savings. You've been living, paycheck to paycheck. You go in and you borrow. Say, I want to buy this $400,000 house. And what they do is they're going to give you a loan. It's going to be interest only for the first 2 years at a teaser rate. They say to you very quickly, possibly in a language you don't speak, they say to you very quickly that after 2 years your interest rate's going to reset to the market rate and you're going to start paying on the principal after those first 2 years. But don't worry about it. We can get you out of this package after 2 years. Not to worry. It's all going to be good. Sign here on the dotted line. Are you ready to go? Thank you very much. Please. Okay. So that's a 228 with a hard sell. You borrow $400,000. You buy a $400,000 house. You had no down payments. You buy a $400,000 house. You're paying interest only for the first 2 years at this interest rate of 4%. After those 2 years, your interest rate's going to reset to the market rate, and you have to start paying off the $400,000. What that means is your monthly payment, if the market rate is 8%, your monthly payment's going to jump from $1,300 to $2,900 a month. So you were paying $1,300 a month on this mortgage, and then boom, at 2 years, suddenly you have to come up with almost $3,000 a month. A lot of people who were living paycheck to paycheck, who were buying these houses because it was cheaper with a 228 to buy a house than it was to rent, couldn't afford the $2,900, $3,000 mortgage payment. So then what happens? Well, if the house had been increasing in price 25% per year, then you win. If the price had risen 25% per year, the house, actually, it only had to rise 25% overall. But anyway, it doesn't matter. If the price had risen 25% per year for 2 years, a $400,000 house would now sell for, I did the math, $625,000. You go down to the bank, you say, I'm at the reset point. My house is now worth $625,000. I want to borrow $400,000 to pay off the $400,000 I owe you. Woo-hoo. It's a little walnut shell game. And they say, this is great, because now you're borrowing $400,000 against a house that's a $625,000 house. That's a loan-to-value ratio of 64%. You're below that 80% cutoff. It's almost like you had saved $225,000, but you hadn't saved that money at all. It was just the house price went up. And in the meantime, of course, you had cleaned up your credit score. Well, you were supposed to anyway, clean up your credit score. So in the meantime, during those 2 years, while you were paying that $1,300, you were supposed to pay off all of your credit cards, make sure you made all of those payments on time, get your credit in really good shape, get a raise here and there, so that your FICO score went up to above 660, and then they could refinance you into a standard mortgage, at a fixed 30-year fixed rate mortgage at a good interest rate. There were lots of people who pulled this off. All right, lots of people managed to pull this off. But if the housing price didn't go up so much, or if you didn't clean up your credit score during those 2 years, or what was my third choice? Yeah, those are the two. Right? You didn't clean up your credit score, or the house price doesn't go up that much. Then what's going to happen is you're not going to be able to refinance. If you can't make that $3,000 a month payment, you're going to default on your mortgage, and they're going to take your house. They're going to foreclose on your house. That's the beginning of the crisis, because those prices going up so fast, well, we know what happens there. There's abnormal profits that brings other developers in, other people start building houses, so there's all of a sudden a big increase in supply, the housing prices come back down a little bit. I think we did that one on a problem set. Now, oh good, 3 minutes for AIG, sure. So the banks were not too worried about people defaulting. And in fact, the people who had bought these mortgage-backed securities were not too worried about people defaulting on their mortgages because they had bought insurance that was insuring them against losses. So the bank or the owner of that mortgage-backed security buys an insurance policy, and that insurance policy will pay out if the borrower defaults. That's called a credit default swap. We're swapping the credit risk between the lender and the insurance company. The insurance company that issued most of these credit default swaps you may have heard of is a company called AIG, American International Group. And they issued somewhere, the estimate is something around $60 trillion worth of credit default swaps. The problem with these credit default, well, there are many problems, but one of the things with these credit default swaps was the way they worked was anybody could buy a credit default swap. Not just the person who was the lender, but anybody could buy a credit default swap. You could buy a credit default swap against whether or not I was going to default on my house. So you buy, I've got a different example, Joe. So Joe's buying a house. You buy a credit default swap on his house. If Joe defaults, you're going to get $100. You pay $2 a year for this little gamble. It's sort of like betting on the don't pass line on the craps table. You're betting that Joe will default. The insurance company is betting that Joe won't default. It all seemed to work out pretty well unless lots of borrowers defaulted at the same time, which they did. And then the insurers, like AIG, can't pay back all of these credit default swaps, which they couldn't. And then the lenders say, I'm not making any loans if there's no insurance against this, if I can't get a credit default swap, which they couldn't. And that's what led to the September 2008, oh my God, we're all going to die. Because AIG said, we don't have enough money to pay back all these credit default swaps. The financial institution said, we're not going to lend if we can't get these credit default swaps. People didn't realize that businesses were dependent upon loans in order to make payroll. And so they fired thousands of people straight away. Wow. And then consumption, investment, government, net exports. All right, let me jump. Oh, I can't jump to the last slide. So now here we are, 2014. I got to take one or two experiments. Here we are, 2014, jumping to the last slide. Things are a heck of a lot better than they were in 2009, 10, 11, 12, 13. Right? So we've got an unemployment rate that's below 6%. You get on your essay to talk about whether or not when the Fed's going to start increasing interest rates and what effect that's going to have. That's your task. That's your next task. Before you walk out, let me say a few things. This whole thing works because I have a whole lot of help. So I had Mariko up in the booth. Thank you very much, and Ezra behind her. I had 12 fabulous GSIs and a fabulous head GSI. And I had all of you, because without you, I'm just somebody standing up in the booth talking to a screen. So thank you very much. Go Bears. Stay dry.